Welcome to This Week in Money. I'm Jim Goddard. Today, Doug Casey from CaseyResearch.com believes silver is shinier than gold for potential investment. He tells us why. How likely are you to have your bank account raided to prop up a failing bank? Financial consultant Richard Knowles wades in on that debate. We talk to Doug Casey right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
Our guest is Doug Casey, founder and chairman of CaseyResearch.com. He spoke to This Week in Money's executive producer, Tom Allen.
Doug, it's always great to see you.
Likewise, Tom, and it's a pleasure to be up here in Vancouver, which I consider the nicest city in North America by far.
We're at the Hotel Vancouver. We're at the Sprott Natural Resource Symposium. What has the mood been like here?
I think looking at the psychology of the resource market, it's the bottom, quite frankly. By most indications, declines in the price of most of these stocks from their previous peaks of 3 years ago, the psychology of people out there, just the general feeling that I get. I think we're at a cyclical bottom in these stocks. Now, it's tough to call a bottom because if the economy collapses later this year or next year, something which I actually think is likely to happen, I think we're in the same situation that we were back in 2007, except much worse. The government's not going to be able to paper things over this time. They've already shot that arrow, bringing interest rates to near zero and printing up trillions of new dollars. Nonetheless, I think the economy is about to collapse. So maybe these resource stocks are going to go much lower again. It's quite possible, but well, there's always risk in the market. But I think you have to be a buyer of quality junior resource companies at this point. And the emphasis is on the quality, because you've got about 1,500 stocks traded up here, and I'd say that really only 50 to 100 should even be considered for buying.
Interest rates are low. The bond market, is it a concern?
The bond market is the biggest concern we have. The bond market is much bigger and much more important than the stock market. And as we speak, it's in a gigantic bubble. As far as I'm concerned, it's the biggest bubble in world history. It's bigger than the South Sea bubble. And it's going to be just as historic in its consequences when it collapses. Of course, all governments, who are almost all net borrowers, want to see interest rates as low as possible, which means the bond market, which moves inversely, is as high as it can be, because they're borrowers. But you know, even with interest rates at all-time lows at the moment, the U.S. government, owing about $18 trillion of debt, has an interest bill of about $250 billion per year. All of its debt is very short-term T-bills and being financed at near zero interest rates. When interest rates go back up to even the current level of inflation, the government's going to be looking at $1 trillion annual interest bill. I don't know how they're going to finance that, plus their defense spending, plus their welfare spending. And even now, as we speak, they're running a deficit in between $500 and $1 trillion per year. That's a very serious situation.
With the bond market, if it heads south, will it likely hurt the stock market and or the U.S. dollar?
Well, historically, the stock market fluctuates inversely with interest rates. The higher the interest rates are, the more money is drawn to debt instruments and drawn out of the stock market. At the same time, the higher interest rates are, the more it costs companies to borrow. So, sure. The problem is when interest rates go up, it's likely to take the stock market down for just that reason. And by all historic parameters, price-earnings ratios, dividend yields, price-to-book value ratios, the stock market at this point is severely overpriced. I wouldn't want to be in the stock market, especially with the bond market on the edge of a precipice, especially with the economy itself on the edge of a precipice. It's very, very dangerous the way people are chasing after yields today. Even junk bonds yield less than 5% as a group. Junk bonds yielding less than 5%. So I think in the next few years, people are not going to be concerned about return on capital. They're going to be concerned with return of capital. It's a very dangerous situation we're in now.
Will the U.S. dollar likely remain the strongest currency?
The U.S. dollar is on its way out as the world's international currency. As you're aware, the Chinese and the Russians have cut a very big deal that they're going to be trading petro products, natural gas primarily, and not using the U.S. dollar. And why should they use the U.S. dollar? It's a floating abstraction being issued profligately by a government that neither one of them likes or trusts. Same thing is happening between Iran and India. It's happening now between Brazil and South Africa and Russia. With the BRICS are forming their own currency union. Nobody likes to use the U.S. dollar because not only because holding it is like holding a hot potato. There's 7 trillion of the things outside of the United States, and nobody has to accept the U.S. dollar. Only Americans have to accept the U.S. dollar by law. So the dollar is a potential hot potato, and all of these foreign countries are looking for a different way to settle. They don't like using the U.S. dollar, among other things, because when they settle with it, oil, for instance, everything, it has to be cleared through New York. And especially countries that don't have good relations with the U.S. government don't like their money going through enemy hands. So it's very problematical.
Would this potentially be looked at as financial warfare that may or may not lead to a bigger war?
That's a good question, because the nature of warfare has changed from what it was in classical times. You know, in the days of the Roman Empire, if you had a powerful military, war could serve an actual economic purpose. You find some country that's wealthy, you invade it, you steal the cattle, the gold, the artwork, the women, you sell all the men into slaves, you make a lot of money. So it actually, and then you could tax them for X number of years until you ran the country until the wheels fell off of it. So sure, I can understand the economic reason for warfare in the past, but you can't do that anymore. I mean, like if the Chinese decided to invade the U.S., you can't. I mean, the real wealth is in technology and in skills, and you can confiscate the farmland, but when people are working as slaves in the fields, it's not very productive. So warfare is, the nature of it has changed from an economic point of view. So still, people have conflicts. And if you want to destroy the enemy today, the low risk and high cost benefit way of doing it, or making it very economically efficient, is economic warfare. You launch a cyber attack, perhaps. That's a lot cheaper than sending a gigantic army to invade and then maybe getting reinvaded. So yes, cyber warfare is the wave of the future. And also I've got to say that so-called terror warfare is another thing. I mean, the U.S. very stupidly might spend $2 million on a cruise missile to blow up a bunch of desert sand, while some guerrilla can spend a $1,000 shoulder-launched missile to take out a $50 million F-15, or a $200 IED by the roadside taking out a $5 million tank, or a teenager with an AK-47, which they have in endless supply, taking out just an average U.S. GI, where the investment and the costs involved in his death, it's $1 million. So warfare, like everything else, is a cost-benefit type of thing. And the U.S. is bankrupting itself with its gigantic, bloated military, and it's completely uneconomic for it to even try to fight a war under the conditions that we've just been talking about.
With all the people being paid by the governments in one form or another, whether they work for the government as bureaucrats, politicians, whether they're getting welfare pensions and so on, how can governments continue to afford this?
Oh, it can't afford it. That's the whole point. The U.S. government is bankrupt today. The official debt is closing in on $18 trillion, and unfunded liabilities, things like Social Security and Medicare and Medicaid and pension funds, bring it up to $65 trillion, and some estimates have been made that it's actually more like $200 trillion. So the U.S. government is totally and absolutely bankrupt. The average American is absolutely bankrupt. More than 50% of the population is a net recipient of benefits from the government. 50 million Americans are on food stamps. And then you have all these useless mouths. They're worse than useless mouths. They're counterproductive mouths in the form of federal government employees of all type that are hauling down net benefits 50 to 100% more than their equivalents in the productive economy is. It's an unsustainable condition, and if something's unsustainable, it can't go on. That's the definition of it. Now the question is just how long can it go on before it comes to a halt? But we may be close to that point.
Is there a way to turn it around?
I don't think it can be turned around. It's like a snowball falling from the top of a mountain. It started out as a small, slow-moving snowball. In the case of the U.S., I'd say about the time of the Spanish-American War, when the Americans first started building their international empire. And the snowball got bigger and rolled faster with World War I, and then with all of the programs of the Depression and World War II. So at this point, it's a gigantic avalanche that's most of the way down the valley, and it's roaring. And you could have stopped that snowball, but you try to stop an avalanche, and you're going to get crushed. And I think the village at the bottom of the mountain is going to get smashed to smithereens. So I don't think there's a solution. There's not a political solution. Even if Ron Paul had been elected president in the last U.S. election, it wouldn't have changed anything for a number of reasons. First of all, I think he would have gotten a sit-down from the heads of all the Praetorian agencies like the FBI and the NSA and the DEA, there's a dozen of them, plus a bunch of generals and admirals, and they would have given him a sincere and severe talking to about how things are not going to change if they have anything to say about it, and they do. And if he disregarded them and survived, he'd have to deal with the Congress and their laws. They'd impeach him. And he'd have to deal with the court system. That wouldn't work. And he'd have to deal with riots in the streets. No, so it can't be turned around politically. We've got to wait until the second law of thermodynamics brings things to entropy, and then see what happens. Question is will it get worse? Because once we reach a position of financial chaos, usually what happens is some populist type starts promising things to all these unhappy people who have lost a lot, and it usually amounts to stealing things from other people that have stuff. And this is typically what happens when you have a revolution. So I'm hoping we don't have a revolution.
More with Doug Casey next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. This Week in Money's executive producer, Tom Allen, continues his conversation with Casey Research founder Doug Casey.
Canadian government passed a provision allowing bank bail-ins.
A couple other European countries following the example of Cyprus, which confiscated everybody's bank account above 100,000 euros. And it worked out pretty well for them because the average person wasn't hurt because he had less than 100,000 bucks in the bank, and they're envious of the rich people that did and the foreigners that did. Foreigners don't count. So sure, good chance they'll do that here or in the U.S. or in other countries. Seem to have worked for them in Cyprus. Very problematical, because if you produce more than you consume and save the difference, typically you save it in dollars. But where do you put the dollars? In a bank. But if you're successful and get over a certain number, they might just steal it from you. It's really a bad situation.
Jumping around, we keep hearing about 99% versus the 1%. Who started the 99 versus 1% campaign?
Yeah, I don't know who forged that meme, but there's unfortunately a lot of truth to it, because since the government has become very prominent in the economy, people expect it to be there and solve things and do things. The people that are close to the government are the ones that are profiting most. They're the ones that stand closest to the fire hydrant of new dollars that are being created by the Federal Reserve and spent by the U.S. government and by its contractors. So the rich have been getting richer, and they're the politically correct, connected people. And they're also the people that can hire the lawyers to take advantage of all kinds of laws, hire the accountants to minimize their taxes, hire the investment advisors to get into the best deals. So yeah, the rich have been getting richer at an accelerating rate for political reasons. Meanwhile, the middle class and below have been ground between the millstones, as Lenin said, of taxation and inflation. They see that the rich are getting richer because of their political connections. There's resentment building up. It's a very volatile situation. And, the unfortunate thing is you get rich today, chances are very good you've done it through political connections. So I hate the idea of eating the rich, but sadly, a lot of these rich people deserve to be eaten. Not that that's going to solve anything.
So are they part of the political class, or is that different?
No, they're all part of the political class. The Turkish have a term for what's I've just been talking about. It's called the deep state. They understand that government isn't a question of the legislature and the executive and the judiciary working together according to a constitution to do things the right way and the voters throwing out the bad guys. They realize this is all bullshit. In the deep state, you've got the top people in the military and the guys that run big corporations pay themselves gigantic salaries and bonuses, guys that run investment banks, top government officials, even mafia guys, people like that are entrenched in power that all work together behind the scenes. So the Turks call that the deep state. And it's so rooted in the U.S. and, for that matter, in Canada, that it's going to continue to exist until the current system resets itself. Once again, not a good situation. It's not. It's no longer a textbook example of how a free country works.
Silver. The way silver is quoted up till August 14th, it's a London silver fix, and it's going to become the London silver price. What's the difference?
I don't know. I don't think it makes any difference. I mean, ultimately, the price of whether we're talking silver or soybeans or cattle or copra or jute, you name it, stocks, bonds, ultimately, it's set by the number of buyers versus the sellers. So that's one exchange. And, all commodities are increasingly traded worldwide on different exchanges. I know that some people might think that there's some kind of a conspiracy going on here, but I'm not concerned about it. When I want to buy silver, and I like silver as a speculation, incidentally, even more than I like gold at the moment, although it's a very different metal, I'm not concerned about that.
Geopolitically, where is it safe to invest?
It's not really safe to invest anywhere because all the world's bond markets and stock markets and even real estate markets are overpriced. Now this sounds like it's metaphysically impossible. How can everything be overpriced? But that's what happens when all these central banks are creating trillions of new currency units. It flows into the asset markets and takes all of their prices up. So it's tough to find a safe place to run and hide today. I'm afraid that, I buy gold coins just about every month. I put them aside. Gold is reasonably priced, not a giveaway bargain the way it was in 2001. Very reasonably priced, and it's the only financial asset that's not simultaneously somebody else's liability. So I buy gold, I buy silver, but I'm very cautious about most financial assets at this time. The time is going to come when there'll again be bargains, and at that time, I'll perhaps even sell my gold and trade my gold for shares of common stocks when I can get them for 10% in average dividend yields. It's not a prediction, but it's certainly a possibility.
Casey Research. What's new? What's going on with Casey Research?
Well, we publish a bunch of newsletters, including a number of free publications, so I invite any of your listeners to come to caseyresearch.com and sign up for some free newsletters. They're really very, very good reading, quite frankly. So nothing to be lost, a lot to be gained.
Can we end with a joke? Sometimes you always have a joke.
You know what my favorite joke is?
Okay.
It's Einstein and interest rates, okay? So Einstein dies and goes to heaven. And St. Peter, of course, is very pleased to see him there and greets him effusively, but tells him, Mr. Einstein, I'm really embarrassed, but we have a housing shortage here in heaven at the moment. Well, for obvious reasons, we're a centrally planned economy up here. So, Einstein says, that's all right for the time being. And St. Peter puts him up in a condo with 4 other guys, and with 3 other guys. And the other 3 guys, of course, are thrilled to have Einstein as a roommate. First guy comes up to him and says, "Mr. Einstein, what a pleasure. I'd like to get to know you better. I have an IQ of 130. Einstein says, "Oh, that's very good. I've been bouncing around a few concepts of astrophysics. Let's get together and chat about them after lunch." Second guy comes up to him and says, "Mr. Einstein, I'm not as smart as that first guy. I've only got an IQ of 100, but I'd still like to get to know you." So Einstein says, "Very good. Well, let me put my grip away and let's play a game of chess." Third guy comes up to him and says, "Mr. Einstein, I'm not as smart as those other 2 guys. I've only got an IQ of 70, but I still want to get to know you." So Einstein says, "So where do you think interest rates are going?"
Very good, very good. Doug, thank you for this. I really appreciate it.
My pleasure, Tom.
Once again, that's Doug Casey of Casey Research speaking with This Week in Money's executive producer, Tom Allen. After the break, Richard Knowles of Knowles & Associates next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is financial consultant and 5-star wealth manager recipient Richard Knowles of Knowles & Associates in Vancouver. Welcome to This Week in Money, Richard.
Thank you for having me.
Richard, today we're going to be talking about the Canadian scheme for buy-ins, or bail-ins as they call them in Canada, to help out the banks if they have a big financial crisis. I think the biggest fear people have right now is, could the same thing happen here that happened in Cyprus, where they just decided that if you had an X amount of money more in an account, they could take that money, calling it a surplus, and people lost tens of thousands of dollars from their savings because of it. Will Canadians face the same kind of crisis if the government decides to do a bail-in for the banks?
Well, the question has a couple of points to it. If you have to understand the banking system in Canada is not fully protected. We do know already, even without a bail-in concept even put on this in any way, which I'll define that in just a minute. But as it stands today, most people are not in the know here, but it should be, that the Canadian Deposit Insurance Corporation, which is a government-based organization, CDIC, it's a type of insurance on our deposits for the banks in Canada. So the members that are part of CDIC, if you have savings, dollars in the savings and checking accounts of a particular bank that's CDIC protected, or credit union, or even trust company, then there's a reason why the government has imposed a CDIC protection of $100,000. Basically, it's $100,000 per different type of account. So you might have an RSP of $100,000. You could have a joint account with someone for $100,000. You could have a savings and checking account on your own name for $100,000, etc. So there's a list of these things, but each one will have it's not a total of $100,000 for all your accounts. It's $100,000 per type of plan. So it could be quite a large sum, but there's only a set number of those. So you might have, I believe, there's a total of about 5 different categories, of which that would probably give you, if you maxed everything out in every different type of category, about $500,000 of coverage for all of your investments. Now, for many people, that's enough. But for many wealthier people, that's certainly not going to handle all of their savings they may be putting aside in a bank, or any particular bank. The best way for them to do it would be to spread between different banks if you're worried. But let's look at that whole modus operandi. Why would we have CDIC? Why is there an insurance corporation on the banks? Well, in case of failure of our banks today, as it stands, no bail-in issues here being involved, but if there was a failure of a bank today, you could lose all your deposits up to the insured maximums. There's no obligation for Royal Bank to pay you any more. If they went under, there would be no obligation for that bank to pay you any more than what is under the Insurance Corporation of Canada today. Now, what's happened with bail-in procedures? Well, with bailing in, the idea would be, and has occurred to the governments of the world that there's a requirement, according to a precedent set in the United States particularly, where they will pay 100% of a bank's losses to ensure that that bank does not go under. Now, this is a big change, especially from a capitalist society like the United States, which says, typically, they say in their mandates, well, if you fail on your own, there's nothing we're going to do about it. But they set a new precedent where they would bail out their banks because they're too big to fail. This has been their expression. You're just too big to fail. We can't allow you to fail because you're too important to the infrastructure of our banks. So consequently, we have this kind of awkward situation, we'll put it, where we have a realization going on that, wait a minute, it is possible for big banks to fail. So if big banks can fail, Canada has not really globally, they're not the biggest banks, but they are big to us, and they are very important to the infrastructure of our country. In fact, so important that we've been protecting it from a political standpoint from any kind of incursions from global banks. So we have a protectionist approach to our own banking system, and more power to us. However, at the end of the day, there is the possibility, now that we've looked around the world, that banks can fail, and if the precedent now is believed to be that the government will use taxpayer dollars, that the people of the country will be bailing out these large financial institutions, we felt, at least there's discussions to discuss what the procedure would be just in case something like this were to happen in Canada. Now, clearly Canada does not have a lot to fear, considering we did not expose ourselves to this kind of weakening banking fiasco that occurred in the global banks with, redesigned mortgages and all sorts of really bad investment products that were created by a bunch of Goldman Sachs guys and under the new Glass-Steagall Act in the United States. And this would not have even happened in the United States had they not restructured the Glass-Steagall Act, which stated that investment banks could get into normal banking and own normal banks and do normal lending. If they had kept it the way it was prior to under the Glass-Steagall Act, which prevented investment banking from mixing with commercial regular lending banking, this actually would not have occurred. We would have not had these problems in the United States, and these mortgages would have not been, these garbage mortgages would have not brought the United States banking system and insurance companies to their knees. So, that's history. Now, they could rewrite their own history, go back to the way they used to do things, which they contemplated doing, but of course the political will is not there. Just follow the money, as we say. But in Canada, we have not allowed this destructuring of the commercial system of banking to investment banking. We don't have the inherent type of problems. So we could talk about our banks failing, but we don't really feel that there's going to be a big risk. We already have CDIC insurance for most depositors' money anyway, which is government protection, by the way. So we already have government insurance paid by the tax dollars to protect our own deposits. So anything above that is still currently a risk. So now let's talk about the whole bail-in discussion. Canada has addressed what if. So they want to discuss what if a bail-in situation occurs. What does that mean in Canada? Well, in Cyprus, they wrote their own kind of definition. They have their own little dictionary on this, Jim. Their dictionary states bailing in means that the government will not bail out the banks. So the banks have to pay on part of this loss. So their corporate profits have to be used before taxpayer money would be involved. Okay? That's their definition. Now, the banks then in Cyprus defined it a little step further. They said, well, look, if we're going to suffer, then our depositors suffer. So we're going to go after percentage of our depositors' assets. If we have to go down, they go down. That's the Cyprus banks. Okay? That's the way they defined it in their country. But unfortunately, we're using the same terminology here as bail-in around the world, but it's actually defined differently here in Canada. We're not talking about depositors' money. At this time, the discussion of bailing in is a corporate banking relationship that would have with the bank, or with the government. So the government says to the banks, look, we want to talk about what-if scenarios. If you guys go down, you already have other creditors. So as it stands today, if a bank were to fail, we have CDIC insurance to protect depositors, and the rest of the assets of that bank, whichever bank you want to pick that's going under, would go to the depositors, to the shareholders of that bank, to the bondholders of that bank. There would be a timely liquidation by a trustee to sell off all the assets, all the buildings they own, all the other investments, and including, by the way, any depositor's money. This is as it stands today, without the bail-in. Any depositor's money above the CDIC insurance is owned by that bank and would be part of the settlement of any debts to that bank.
More with Richard Knowles next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking to Richard Knowles. Richard, you were just mentioning off air there's a banking regulation most Canadians don't know about, and it's pretty shocking.
Unbeknownst to a lot of Canadians, and it should be made aware every single day of your life, the money you put in a bank is not yours. It is a loan to that bank, and it becomes the bank's assets. That's in your checking account, in your savings account, in any RSP GICs you might have there. Anything that is held in anything except a mutual fund is owned by that bank. If the bank goes down, your assets are not yours. They are the bank's. You are lending it to them, and they pay a nominal interest rate to pay you back into your savings accounts and checking accounts for the use of your money. In fact, it's become so insulting that they not only not pay us an interest rate, but they charge us fees for using their services, because that's what they're there. They're a service provider, and they're charging you for that service. But it's not as though the money is yours. You do not have a right to that money. It is theirs by law. They own it. You have a right to go and get it at any given time unless they don't have the ability to give it to you. So if a bank is going under and they lock their doors and they say, sorry, we're done, we're finished, you want your money out. You say, that's my money. And they go, no, that's our money. But you happen to have CDIC, Canadian Deposit Insurance Corporation, will pay you through the insurance, not from us. It's coming from the taxpayers under CDIC. That's going to pay you up to your maximums, as long as you haven't gone over that maximum. So if you owned $110,000 in your savings and checking accounts combined at a time when your bank goes under, you will be paid, this is today, this is without the bail-in discussion, you would be paid $100,000. You will lose $10,000 because that $10,000 is kept by the bank and it goes to their debtors, it goes to their common shareholders. It's theirs. It's not yours. Okay? Are we clear on that, Jim?
Oh, absolutely.
Okay. So
I was wondering, though, if it's an insurance payout, how long would it take, say a bank closed its doors and your money's frozen, how long would it take the insurance corporation to pay out your insured part of your deposit?
it takes a while. With Prenner Trust, which occurred in Alberta, that's the only really biggest failure we've had. That was back in the late 80s, early 90s. We had a couple of trust companies went under at that time, and 87, 88. Same thing happened in the similar in the U.S. There was a big banking crisis with the unit banks in the U.S. They had a massive banking crisis. There were a bunch of failures. We had a couple here, trust companies as well. And it took them over a year, sometimes a year and a half, to get your insurance out, because they have to go, the trustee has to go through all the numbers, right? They have to verify what was on the assets for all of the depositors. The bigger the bank, however, the longer it will take. So if you've got a massive bank, actual massive bank failure, like, something like TD or Royal or someone, it would take much longer to go through everything. The trustee would be charging a lot of trustee fees as well. The trustee fees are what often are the most expensive costs of a failure of an organization, indeed. So a lot of assets that would be left over would be disseminated to others. Of course, the bondholders first, and then the common share owners, if there's anything left, might get some of their money back, of course. But in a timely liquidation, it would take probably a couple of years at least, I would imagine, for a large bank, chartered bank like in Canada may have, I could imagine.
In Cyprus, they took any amount, I think, over 60,000 that you had. And I know in Canada, it's only in recent history that the insured part of your deposit's gone up from 60 to 100,000. So we really weren't much different than Cyprus at that time, if you go back a few years.
Well, yes. Under the bail-in in Cyprus, it was actually anyone that had any money in there. It was a percentage of your money was paid out.
Oh, a percentage.
Yeah.
Ooh.
It was based on a percentage.
Oh,
and it was a flat amount. It wasn't a flat amount. So you could have had 2,000, but you would have lost a smaller amount, but it would have been the same percentage as a person that has $1 million. So you could imagine I can't recall, I think it was up to... It ended up being, I believe, a graded system. So it ended up being, I think, if you had under 5,000, it might have been 7%. And then the more it went up, the more money you had, it actually went up to a certain maxed cap. So, of course, there was all sorts of crooked things going on as well. Some of the developers that had large money in Cyprus, I happen to have been told, because I have people on the ground there. I was told that these guys were getting off scot-free because they'd already removed all of their money from their accounts before it all happened. So that's kind of interesting how they knew somehow, but nobody else did. So there's a lot of people in cahoots there, a lot of families know other things, and they tip everybody else off.
And of course, Richard, you've pointed out to us in the past that Canadian banks, compared to the shape other banks were in, they're doing relatively well, always have. And have been very strong because they have very strict regulations on who can get loans and what kind of loans can be taken out.
Oh, absolutely. I quote Jim Pattison in a question that he was given one time on CDIC insurance. So they go, well, do you have a lot of money in these banks? And he goes, yeah, I've got a lot of money in the banks, Royal and others. And he goes, are you worried? And the question was, are you worried about CDIC insurance not covering you? And he goes, well, yeah, I don't want to lose a lot of money, but I'm not worried about, any of these banks going under all of a sudden.
Richard, would the government let a bank get to the position where they had to start using your insured deposited money, or would they have some kind of deal worked out so that the bank didn't have to start dipping into accounts and activate the insurance?
It's a deal between the government and the bank. So when the trustee comes in, for example, and says, look, we're gonna let this bank crash. Well, instead, the government would get involved first and say, look, will you make an agreement to bail you out on part of your debts and assets, whatever's going on, right? So, but the bank would be required to bail in some sort of corporate profit, make a deal with the government directly. But that would still, so that the bank won't go under, and so the depositors probably are not going to be approached. It would be a corporate deal between the bank and the government to make some payola deal where the bank will perhaps send profits to the government for a period of years to pay back a loan, for example. That type of bail-in procedure, so that the taxpayers are not hooked on bailing out the bank 100%. That's what the discussions are. What they end up with, we don't know. But so far, CDIC and depositors are not being put on the block here. So if everybody's concerned, but everybody should always be concerned about what we've got with CDIC, right? Like, that's not changing. They're not saying they're protecting everybody's assets 100%. They're just saying that there won't be a way for the bank to come after the depositors for any more money if they make a deal with the bail-in with the government. That means the bank is not going under. CDIC is not being triggered. And they would not be going after money within the accounts. So that's going to be excluded in the bail-ins procedure, which is an important factor.
Richard, is there a website or an email address people could go to if they had any questions for you about this?
Yes, you can contact me on my corporate email at Richard and the letter K, one word, Richard K, at customplanfinancial.com. I'd be happy to receive any questions.
Thanks to the participants in today's show, Doug Casey, Tom Allen, and Richard Knowles. And thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.